Ed, next one we should look at is Wesfarmers, of course, ownings of Bunnings Warehouse, Kmart, Officeworks, and as of late, Priceline, the pharmacy as well. How did it go?
Wesfarmers, Ross, did pretty well today. They had a good half. Net profit was up about 14% to $1.4 billion, and that was off the back of revenue jumping 27% to about $23 billion. Bunnings sales jumped 6.3%. Kmart were up 24.1%, and sales at its chemical division leaped about 30%. The conglomerate lifted its dividend to 88 cents per share and increased its return on equity by 80 basis points to 32.8%. Wesfarmers says trading through the first 5 weeks of the new year have been broadly in line with the growth reported for the first half, so no slowdown in sales at Wesfarmers, unlike JB Hi-Fi and Temple & Webster, which have flagged slowdowns in consumer spending. And Ingrid, how did the Wesfarmers shares go today?
Yeah, well, Wesfarmers performing pretty well today after its numbers, with the stock you can see up about 1.3% at the close. Now, investors no doubt welcoming the dividend. The yearly chart you can see up near its highs of April, but Vanek thinks this result will be hard to beat in the future, so we may be close to a top. Now, of course, it's a conglomerate, so it's not easy to get clear comps for this one, but you can see here a couple of different comps. Seven Group up 1.3%, Woolies down about 0.8%. We've also got Whitehaven Coal in there, up about 3.5%.
Yeah, thanks, Ingrid. Well, I also spoke earlier with the Wesfarmers Chief Executive, Rob Scott, who curiously says there's little signs so far of a slowdown in consumer spending, and especially at Bunnings.
Yeah, we did signal today that we've seen a continued strong level of trading across our businesses at the start of 2023. But I think it's worth remembering that a lot of our businesses, the Kmart business, Bunnings, Officeworks, are renowned for their everyday low prices. We are seeing signs that customers are more value conscious. They are hunting out for better deals. So I think that is playing to the benefits of our retail brands. Looking forward, we still remain quite cautious around the economic outlook and what it means for households. What we're seeing across our businesses is some of the international factors that were impacting cost and inflation, international supply chain, transport costs and so forth. Those pressures are normalising. We're actually seeing some raw material prices come down for a lot of our products. The issues that concern us most at the moment are the local domestic costs of doing business pressures. So this goes to labour availability, energy cost pressures, also increasing costs of transportation. Then when combined with potentially higher mortgage rates, that is likely to put more pressure on consumers.